You've definitely seen the image, right? A central bank firing up a giant printer, just flooding the economy with cash. It's one of the most powerful ideas in economics. But is it actually true? Today, we're going to go behind the scenes of monetary policy to find out how it really works.
So, let's get right to it. When the economy needs a little bit of a boost, do central banks just hit print? I mean, it's a really compelling idea, but the reality? Oh, it's way more complex and, honestly, a lot more interesting. Let's start with where this whole money printer idea even came from.
All right, to understand how we got here, we have to travel back in time a bit to a theory that a lot of us probably learned in school. It's called the money multiplier, and it's an idea that's been so hard to get rid of that one central bank paper actually calls it a zombie economic idea. Yeah, a zombie.
So this is that classic theory in a nutshell. The whole idea was pretty simple. The central bank creates what's called base money or reserves, and then the commercial banks, they take that base money and multiply it throughout the entire economy by making loans. You can just picture it as a simple, almost mechanical process.
Here's how it was all supposed to play out, step by step. The central bank injects funds. Banks are required to keep a little bit of that on hand. That's the reserve requirement. But then they lend out the rest. That loan becomes a new deposit in another bank, which then lends out most of that, and so on and so on. The theory was that a small initial action would have this massive and, more importantly, predictable effect. But here's the twist. This tidy little model is something central bankers themselves have called a fiction.
So what happened? Why did this really elegant, simple theory just fall apart? Well, the connection between the amount of money in the system and what was actually happening in the real economy just started to break down completely. Let's dig into why.
Well, according to the San Francisco Fed, a few things basically broke the machine. First off, financial innovation. Money wasn't just cash in a bank anymore. All of a sudden, people could move funds instantly into things like mutual funds, which completely blurred the lines of what money even was. But maybe most importantly, the velocity of money. That's how fast a single dollar gets spent and then respent. It became totally unpredictable. The once reliable link between the quantity of money and the health of the economy was just gone.
And the final nail in the coffin? It really came in 1993. The Fed chairman at the time, Alan Greenspan, basically announced the death of the old model in this testimony to Congress. He said flat out that the Fed would no longer use these money measurements to guide policy because, well, they just didn't work anymore.
So, if trying to control the quantity of money was a total dead end, what was the alternative? Well, central banks shifted their focus to controlling something else entirely, the price of money. And we know that better as the interest rate. So the modern approach is what we call the interest rate channel. Instead of trying to micromanage the amount of money in every single bank, the central bank now sets one single, really powerful target, its main policy interest rate. This is the new lever for steering the economy.
And here's how it actually works in practice. The central bank changes its main rate. That immediately affects how much it costs for commercial banks to borrow from each other. That cost then ripples out, or transmits, to the rates that banks offer us on mortgages, car loans, and business loans. So, by making borrowing either cheaper or more expensive, the central bank influences our decisions to spend and invest. And that, at the end of the day, is what really drives the economy.
Now, this system, it worked pretty well for a while, but after the 2008 financial crisis, it hit a massive roadblock. Central banks had already cut interest rates all the way down to zero, and the economy still needed help. So what on earth could they do when their main tool was basically maxed out?
This brings us right into the modern era of what's called unconventional policy. When you literally can't cut interest rates any lower, you have to get creative. So let's take a look at the new tools in the toolbox, especially the most famous one, quantitative easing, or QE.
This comparison really shows the difference perfectly. A normal rate cut? It mostly affects short-term rates, what you'd pay in a loan today. QE is totally different. It's designed to influence the entire yield curve. That is, interest rates across all different time horizons, especially the long-term ones, like the rate on a 10-year government bond. It's about changing the price of money not just for today, but for years into the future.
So, how does QE actually work? This part is absolutely critical. It is not printing money to just hand out. It's an asset swap. The central bank buys a long-term government bond from, say, a pension fund. The pension fund sells the bond and gets cash, or more accurately, central bank reserves in its account. The real key here is what the ECB calls duration extraction. The central bank has basically removed a risky long-term asset from the market.
This forces investors to reshuffle their portfolios, and because there's less of that long-term risk to go around, the extra payment investors demand for holding it, that's the term premium, it falls. That's what pushes long-term interest rates down.
And the effect has been massive. I mean, according to the European Central Bank, without these unconventional policies like QE and negative rates, 10-year government bond yields in the euro area would have been almost 1.4 percentage points higher back in 2018. That is a huge difference in borrowing costs for governments, businesses, and for all of us.
This all brings us to the world we live in right now. Years and years of these policies have fundamentally changed the financial system, and that's led to a new and pretty complex challenge.
You see, the side effect of all this massive bond buying is that the banking system is now just awash with liquidity, with central bank reserves. There's a massive excess supply, and this has created a really strange new environment.
Researchers at the Dutch Central Bank actually have a name for this: the excess liquidity trap. In this state, there's just so much liquidity sloshing around that the old policy levers don't really work the same way anymore. The financial system itself has changed, creating a trap that these researchers argue cannot be solved by monetary policy alone.
And this leaves us with the final and most critical question for today's policymakers. We've moved from the simple fiction of the money printer to the complex reality of interest rates, and now to a world that's just flooded with liquidity. In this new reality, can central banks still steer the economy all on their own? Or is a totally new chapter in economic policy about to begin? That's something to think about. Thanks for tuning in.